A 1031 exchange, also known as a like-kind exchange or a tax-deferred exchange, is a provision in the United States Internal Revenue Code that allows investors to defer capital gains taxes when selling certain types of investment properties and reinvesting the proceeds into similar properties. The name, 1031 exchange, comes from Section 1031 of the Internal Revenue Code, which outlines the rules and requirements for this type of transaction. Here are the key aspects of a 1031 exchange. Eligible properties. The 1031 exchange applies to investment or business properties held for productive use in a trade, business, or for investment purposes. It does not apply to personal residences or properties held primarily for sale. Like-kind requirement. The properties involved in the exchange must be of like kind, which means they are similar in nature or character. The definition of like kind is quite broad for real estate exchanges, allowing for a wide range of properties to qualify. Exchange process. To initiate a 1031 exchange, the property owner must engage the services of a qualified intermediary who acts as a third party to facilitate the exchange. The qualified intermediary holds the proceeds from the sale of the original property and ensures they are used to acquire the replacement property. The property owner must identify the replacement property within 45 days of selling the original property and complete the purchase within 180 days. Tax deferral. The primary benefit of a 1031 exchange is the ability to defer the payment of capital gains taxes on the sale of the original property. By reinvesting the proceeds into a like-kind property, the property owner can defer the recognition of the capital gains until a future taxable event, such as selling the replacement property without doing another 1031 exchange. This allows investors to preserve their capital and potentially grow their investments faster by reinvesting the full amount of the sale proceeds. Boot and taxable gain. If the taxpayer receives cash or other non-like-kind property, known as boot, as part of the exchange, it may be subject to immediate taxation. The taxpayer must report the boot as capital gain in the year of the exchange. Additionally, any gain not deferred through the exchange is also recognized and subject to taxation. It's important to note that while a 1031 exchange allows for tax deferral, it does not eliminate taxes entirely. Eventually, if the property owner sells the replacement property without performing another 1031 exchange, the deferred capital gains taxes will become due. Due to the complexity of 1031 exchanges, it is highly recommended to consult with tax and legal professionals who specialize in real estate transactions to ensure compliance with all the rules and regulations governing these exchanges.